Hey all, good morning and welcome to ShareTrack. This is Raj here. Today we are going to take a deeper dive into the liquidity injected by central banks during the COVID pandemic and what they are doing now. This is important because instead of listening to commentators, we are going to take a first-hand look at the interest rate changes as well as the liquidity infusion and liquidity removal or quantitative easing and quantitative tightening process to get a feel of when the Fed may ease up and how much the interest rate could go up. And also that will give us an idea of when the markets are likely to turn around. Again, just as in all economic theories, we are saying ceteris paribus or other things remaining constant, how the correlation between quantitative tightening and interest rate hikes may affect inflation. So that's what we are trying to establish. And this in turn provides us with an educated guess on when the markets can rebound. So let's get started. Welcome back, friends. Since the start of the pandemic, the central banks of Japan, the United States, the United Kingdom, and the Euro area have added roughly $10.2 trillion in security assets to their already large balance sheets, letting their total assets soar to around $25.9 trillion as of the end of September 2021. The Fed has been buying around 120 billion worth of securities every month and has accumulated a stock of 2.6 trillion in mortgage-backed securities and 5.5 trillion in US dollar treasury securities. The European Central Bank (ECB) has implemented a Euro 1.850 billion pandemic emergency purchase program, which complements existing asset purchase programs and involves the purchase of both private and public sector equities. And all of that pumps in a whole lot of money into the economy, and that is called as quantitative easing. The worst part of the COVID response from a capitalistic perspective was the money given to people that were locked down in order that they could sustain themselves financially. When seen in conjunction with the supply chain and the manufacturing breakdown that happened around the same time, this led to too much money and demand chasing too few production and supply, a great recipe for hyperinflation, and that's exactly what happened. And between March 2020 and March 2022, the monthly pace of purchases was around $80 billion for treasury securities and $40 billion for agency-backed MBS, that is mortgage-backed security. Overall, as shown in the Federal Reserve System assets graph, security holdings more than doubled from about 3.9 trillion in early March 2020 to 8.5 trillion dollars in May 2022. As a percentage of GDP, the holdings rose from 18% to 35%. See the Federal Reserve asset chart here that shows the status of total treasury securities as of April 6, 2022, which is standing at 5.8 trillion, of which MBS, that is mortgage-backed securities, is at $2.7 trillion. Once the pandemic receded, the Fed started tightening its balance sheet. What most market players have been prominently seeing is the interest rate chart where the interest rate keeps going up. And you can see that here along with the inflation rate chart. And as you can see, the inflation started responding to the increasing interest rates in the month of June. And since June, the inflation rate has fallen as the interest rates continue to increase. There is a hidden reason for this in plain sight, which most of us don't see on a daily basis. Over a 3-month period starting June, the Fed has been letting $47.5 billion worth of assets every 30-day roll off its massive $9 trillion bond portfolio, more formally known as the balance sheet. But starting in September, the Fed kicked off the process further level up by doubling how many treasury and mortgage-backed securities it's rolling off to $95 billion per month. The rate of tightening will continue at the rate of 95 billion worth MBS and bonds, which means that the Fed is taking away a total of around $95 billion every month from the market. And this is starting to make a dent on the inflation. And all these asset tightening activities started in June, and you saw that we peaked out our inflation in the month of June. In the recent past, Atlanta Fed Raphael Bostic and Cleveland Fed Loretta Mester have discussed the idea of the Fed selling its MBS holdings without giving any kind of timeline. So right now what they are doing is all the mortgage-backed securities that are coming up for renewal are not being renewed. And that's the way in which the mortgage-backed security quantum in the balance sheet of the Fed is reducing. But if the Fed wants to get into a more traditional situation where there is no mortgage-backed security in its balance sheet, then it's likely that somewhere in 2024, when the economy is much better, the Fed would potentially start not only not renewing mortgage-backed securities, but also selling a small amount of mortgage-backed securities to accelerate the process of clearing out its balance sheet. However, presently looking at the high mortgage rates and the fragile housing sector, that seems to be a different, very, very distant possibility, and it's too hard to fathom a situation where the central bank would be actually selling mortgage-backed securities, but surely it's going to happen. And as the balance sheet shrinks and more liquidity is taken off the market, along with the interest rate hike, everything else being constant, the US dollar should keep on gaining strength. This would mean that a recession is on the books for the USA because US imports are going to become dirt cheap, and therefore domestic market manufacturing is likely to suffer significantly. US exports are going to be more expensive for the importing countries, and this means that the USA is going to get into a recession, and the rest of the world is going to face a great deal of inflation pressure on dollar-denominated imports, which are basically goods exported by the US, as well as oil and gas. Those are denominated in dollars. Therefore, that's again going to send the rest of the world into a recession. Now, in this context, if you look at the OPEC oil price cuts, which they have announced recently, it seems foolish. But if you look at the OPEC oil price cuts from the point of view of Saudi Arabia, they anticipate recession and a sharp drop in oil consumption, and they are proactively increasing the oil prices so that they can continue to retain their trade surplus and save their economy. Their interest is their self-interest. They're not looking at the global interest. As various actors act out their personal selfish interests, the global economy and our markets will start responding to that. We cannot predict all the actions of all the actors, and hence we are not able to say exactly when the global economy will reach an equilibrium and when the markets are going to rebound. But one thing I can tell you for sure is that the markets will start rebounding at least a quarter before a potential equilibrium is achieved, because the markets are always forward-looking and they react to forward-looking events. I hope that all this makes sense to you, and I was able to explain it much more easily and simply. I look forward to your comments and ideas, and if you have any difference of opinion with me, please put it in the comments below so that I can consider that. And if you like this video, please do not hesitate to press the like button, and if you're not yet subscribed, please subscribe and help me grow this channel. I hope you continue to have a great weekend. I am surely having a great weekend. I had a fantastic meal yesterday. And today again, I think we are going to go out, take some pictures of the fall colors. I'll make sure that I bring back some videos and pictures for you to show here in this channel, and also put it on the community tab. So I hope you enjoy your weekend, and those of you who are in North America, please go ahead and go out and enjoy the fall colors. Bye for now. I'll catch up with you on Monday.